My name is Mike Williams, and I am the retirement counselor for the Indy PERS plan. And today we're going to talk about financial wellness, which is something that I think everyone really should be focusing on. Financial wellness is what's going to make you comfortable when retirement rolls around. And I think it's something that it's never too soon to have a conversation about. So that's what our focus is going to be on today. But before I begin, I just want to give a brief overview about who Empower is. For those of you that are not aware of Empower, we are the provider, one of the providers for the plan, for the Indy PERS deferred compensation plan. But most importantly, with Empower, we are committed to helping people live for today while saving for tomorrow, because we truly do believe in retirement and financial freedom for everyone. So as you can see that there, I think that is a good starting point as we're having this conversation about financial wellness. So what are we going to focus on as we're talking about financial wellness? We're going to focus today on these four core areas, because all these topics go in hand. Whether you're, whatever it is you're looking to do, they do go hand in hand. Budgeting, debt, credit, and savings. So this is what our focus is going to be, because again, as we're talking about financial security and financial freedom, these four core areas are going to help you get there. As I say, they work hand in hand with one another. So I'm going to start off with budgeting. And this is a question that I often ask when I'm having one-on-one meetings with individuals. Do you work with a budget? And unfortunately, more often than not, people will say, well, I kind of have it in my head, or no. So I'm just going to start off with saying, when I talk about a budget to you, I want to make sure that you have pencil to paper, because I think it's very important to know exactly what's coming in versus what's going out. So when we talk about a budget, it just helps you go from wondering or thinking about where your money went to knowing exactly where it should go. That's the purpose of having a budget. So this budget is meant to help you prioritize your spending, help you reduce your debt, and be better prepared when that unexpected expense happens. And I can tell you it will happen. It happens to everyone. Whether we want to believe it or not, there's always some unexpected expense, whether it's your car battery going dead, whether it's you have a pet that needs to go to the vet and there's a issue, or your refrigerator goes out. The list can go on and on and on and on and on. But there's always going to be some unexpected expense. And this is where a budget comes into play. So when you start putting together a budget, it does make you become more aware of your spending habits, and you actually see what you're spending. And really, when you control your spending habits, it gives your finances a sense of predictability, that you can get the most out of your money that you're bringing home every month. So again, we're going to start here talking about a budget, and we're going to talk about why or how to go about putting together a budget. Because essentially, as the topic says, a budget helps you find a balance across needs, wants, and savings. I will share with you one of the things that I always told my kids. You always have to separate your wants from your needs. You may want it, but do you necessarily need it? And that goes true with a budget as well. So a simple rule that we often utilize, called the 50-30-20 rule. It can help simplify your budget. And when we talk about the 50-30-20 rule, it simply says that 50% of your money should go to your needs. Those are your necessary items, like your mortgage payment or rent payment, your groceries, your utility cost, those sort of things. Then the next 30% is really what I call discretionary items. That goes towards the things that you like to do. Going out to the movies, going out to dinner, taking a vacation. Those are discretionary items. Those are things that you may want, but don't necessarily need, but it's where you can put money aside to do the things that you like to do. Because quite frankly, we all need that relief to be able to do the things that we like to do. Again, if it's going out to dinner and having, dinner with friends and family, that's great. But you got to think about how often are you doing it and does it fit within your budget? And finally, the 20% should be put into savings. Now, that can mean paying down debt. One of the things that I always highlight to everyone is making sure that you've got an emergency savings plan. And last but not least, your retirement. So think about that. It's a very simple rule, 50, 30, 20 rule for budgeting. So now that we know the purpose and the benefits of a budget, let's get down to how to actually create a budget. And that starts really with figuring out where your money is going. So as you know, there are a lot of things that can compete for your money, like your housing costs, your entertainment, food, car, cell phone, gas, college expenses if you've got kids, any hobbies that you may have, internet cost. And the list can go on. I can think of insurance and clothing and kids' sports. All of those things are items that are competing for your money. So you got to really kind of put it down. Now, before I move forward, I always recommend when you're putting together a budget to sit down and put pencil to paper, because I think that's the best way for you to really visualize what's going on when you put pencil to paper. So think about all the things that are where your money's going. We all got to have a cell phone from the pictures here. You got car issues. Maybe you want to take a vacation. These are all the things that are competing for your money along the way. So, as I say, a budget is just a spending plan. And when we talk about a budget, it's going to be made up of three distinct components. It's going to be made up of your income. That's the money that's coming in. Where is that money coming from? It's going to be made up of your expenses. What's going out versus what's coming in. And then your goals. And goals is something that we'll talk about, but that is very important. What is your goal for your money? Not to just spend it frivolously, but to really have a goal. And again, this is one of those things that I'm always going to say, with your goals, put them in mind, write them down if need be, but have a short-term goal, a intermediate-term goal, and a longer-term goal. Short-term goal may be to start your emergency savings plan. Intermediate-term goal may be to get your credit card debt or your car loan paid off. Longer term goal obviously can be retirement or some other goals that you set. But set some financial goals, because as you put your budget together, those first two, your income and your expenses, are going to have a direct effect on your goals, your overall goals. So keep that in mind. So as I say, first step is figuring out how much money we have coming in during a typical month. So, that will be your paycheck, any other, if you got a part-time job or a side job, sometimes people have alimony payments or interest from your investments. All of those things are classified as income. Now, the numbers can change from month to month. If it's just your paycheck coming in, you know exactly what that is every month. So, try to keep an eye on what's coming in and really focus on that amount, okay? Because that's the first step in your budget. So once we know how much is coming in, and when we talk about how much is coming in, this is after taxes and all the other expenses have been taken out of your paycheck, then you can go on to the next area and take a look at your expenses. So when we talk about your expenses, this can be a little bit more complicated than just tracking your income, because you know what comes in with your paycheck, you know what the deductions are within your paycheck. But now I want to try to get you to break it down into different categories. Expenses can also be more variable than income. From month to month, it's going to change. So you really want to keep an eye on your expenses and really make sure that you update those expenses every couple of months because they are subject to change. Now, some expenses are going to be identical every month, like your mortgage payment or rent payment, your car payment, maybe other items like your insurance payments. But then there are other expenses that we know will be there, but their exact amount will vary. Your utility cost, I think, is a great example. The price of gasoline for your car, your groceries obviously are going up. So those are what we would classify as variable expenses. Then there are those surprising expenses that do come about. If you got kids, there's always the possibility of a medical emergency. Johnny has fallen and broken his arm, and you got to go to the emergency room to get that taken care of. That's a medical expense. Car repairs, they happen. Your fan belt breaks or the battery dies. Those are expenses that are unexpected, but they do occur. So you have to be prepared for that. And this is why, as I get into this is why I'm always suggesting that you have an emergency savings plan set aside. And then lastly, there's those quality of life expenses, the things that we like. That's what I call the discretionary expenses. Your entertainment, going out to dinner, buying gifts for your loved ones or buying clothing for yourself. These are all the types of expenses that you want to figure out what they are. And again, this is why it's important that you write them down, because you've got both the fixed expenses, you know what your house payment is, you know what your car payment is. Those are fixed expenses. They stay the same every month. But the other expenses can be a little bit more difficult. We're all struggling with the cost of a dozen eggs. So your grocery expenses are going to be variable over time. So it is important to make sure that you get a good handle on those expenses. So once you have a good sense of what your income and your expenses are, now we can sit down and work on creating your budget. It's very simple from this point on. Subtract your expenses from your income. So if the number you get is positive, then your budget can help you figure out where to put your extra money. Can you put more money into savings? Can you pay off your credit card debt a little bit more aggressively? If you've got an expense that's going to be coming up in the future that you know about, well, this can help you plan for it. So that's what you get when your number is positive. If the number is negative, then your budget needs some help along the way, and then you've got to figure out where you can cut certain expenses. So obviously the first place that you may want to cut are those discretionary items. And I'm not saying, I'll use going out to dinner. A lot of folks will spend a lot of money, particularly younger individuals, going out to dinner. You may be single, you don't want to cook. You go out to dinner, you do that 5 times a week or more. That's an expense that you need to rein in. It may be going out to lunch every day. Maybe you need to bring your lunch. One expense that I oftentimes get folks on is stopping at Dunkin' Donuts or Starbucks and getting that cup of coffee every day. Well, it could be something as simple as making the coffee at home, pouring it into a thermal mug, and taking it to work with you. So those are some of the things that you can do if your number is negative. Now, in either case, your budget is going to give you a real understanding of your financial situation. So, your financial needs and circumstances are going to change over time. So you're going to want to revisit your budget periodically. And let me just say, if you have a negative number, don't panic. Okay. You can get that straightened out along the way, and we'll talk about that. Here's just an example of a budget. So In this example, this individual has a monthly take-home income of $2,500 a month. Excuse me, that's after taxes. But they also drive for Uber on the weekend. So there's some additional money coming in. There's an additional $500 that they've gotten just by doing work on the weekend. So they've got a total income of $3,000. Now, as you look, they've got their mortgage expense, there's $2,000, there's $400 for groceries, there's that emergency where they had to go to the emergency room for $150. They like to play video games in their streaming services. So they have expenses of $2,630, which means 3,000 minus $2,630 rather. That's $370 that they can use to do the things that they like to do, or to pay off debt more aggressively. So, just a very general overview of what your budget should look like. Once you put all your income together and you minus out your expenses, you'll see what that number is, whether it is a positive number or a negative number. Now, next, you can compare your income to your expenses, and hopefully you're spending less than you're bringing in and have a surplus each month. If that is indeed the case, then you could think about increasing your retirement savings, growing your emergency fund, paying down your debt more quickly, or some other items that you're going to need to pay for, like college savings or saving for a vacation. So this is what happens when you have a surplus. Now, on the flip side of that, if you have a negative number, if you're spending more than you're bringing in, that means you have a deficit. And I've already stated, don't panic, okay? Do not panic. What you need to do then is just find what the causes of having that negative number, what's causing that. Sometimes it could be something that happened that was out of the ordinary, that kept you or caused you to spend a little bit more from your budget. Again, that can be something like your car breaks down and you weren't prepared for it. That's just a one-off example of something that is a little bit unusual that will make you need to adjust your spending habits for the month or for the next couple of months. I think in most cases, when we talk about negative numbers, that really comes about by credit card debt. Could be some other issues, but I know credit card debt is one of those things. So if you've got a deficit, as I say, don't panic. Just figure out ways that you can reduce that deficit along the way. And then, this brings us to the final pillar of your budget, and that is having some goals. Goals are very important. As I've suggested previously, short-term goals. I often say have intermediate-term goals, something in the middle there. But your short-term goals are paying down your debt, or maybe starting that emergency fund. If you haven't done so, I think that's something that everyone should have, an emergency fund. You may want to save for a new item like a new car, a new refrigerator, whatever the case may be. Then you've got those longer-term goals, which can be a variety of things. It could be, I work for a retirement company, so retirement is always at the forefront of when I'm having these conversations. But there are other things. Saving for college is a big issue for many families. Putting that money away for college expenses. It could be saving for a vacation, or a vacation home. And you guys are in North Dakota. You may want to have a home in a warmer climate at some point as you approach retirement. So there's a variety of reasons and a variety of things that you can put in either short, intermediate, or long term. The point that I want to make that's most important is setting a goal, putting a goal in place. That's really where your focus should be. Now, when we're talking about debt, you want to make sure that you understand or figure out what your debt to income ratio is. And we would talk about your debt to income ratio. It's simply a measure of how much of your income goes towards paying off your debt. And it's really easy to calculate. All you do is take how much you pay towards your debt each month and divide it by your total income every month. And then you'll get a percentage. And the lower your debt to income ratio is, the better you are. So for an example, if you pay $200 a month on debt and you make $1,000 a month, then your debt to income ratio is 20%. So it's easy. It's easy to figure out. And it's also something that goes directly to your credit score. So, your debt to income ratio is going to affect you in a couple of different ways. First, if you have a high debt to income ratio, you'll probably have a harder time absorbing any unexpected expenses that come in. Secondly, your debt to income affects how likely you are to be approved for credit offers that are always coming our way. So if you have a higher debt to income ratio, you could be less likely to get approved for something like a car loan, for example, or your interest rate could be significantly higher for that car loan because you have a higher debt to income ratio. I think the easiest thing to say here is the best way to improve your debt to income ratio is stop accumulating new debt and pay off the existing debt. And, as a rule of thumb, you want to have a debt to income ratio below 30%. So if you've got credit cards, you don't want to spend more than 30% of that balance or of those total balances. That puts you in a better standing in terms of your credit rating. So again, keep that in mind when you're thinking about your debt to income ratio. Now, this particular slide, I do think it's important for those of us that have negative debt to income ratios. But before you can pay down your debt, you got to stop accumulating your debt. So, it's tempting to make, big credit card payments sometimes, but if it turns out that your payment was too big, you may end up using your credit card for other purchases. So you haven't helped yourself out by doing that. So once you know that your budget covers your expenses, then you can practice spending mindfully to help you stay within your budget. So before you make additional unnecessary purchases, ask yourself a couple of questions. Can I afford it? That's the first one. Can I afford it? Do I need it or will I use it? These are the type of questions that you want to ask yourself because then you're really thinking about, do I need it or did I just want it? And if you need it, okay, then that may be worth spending it for it. But if it's just an item that you want, well, maybe you can start saving for it along the way. So again, these are just ideas that can help you along the way. So here's just some tips for paying down debt. You can start paying down the credit card that you may have with the highest interest rate. Start paying that down first. One of the tips that I often pass on to people, and I know years ago I did this frequently, pick up the phone, call your credit card company, particularly in these high interest rate times, and ask them to reduce your credit card interest rate. Simple call. All they can say is yes or no. Okay. So, but if you call them and, ask them to reduce your interest rate, there's a good possibility that they may do it, particularly if you've been paying on time. So that can be something that can help you reduce your debt. Now, another item that I always stress, pay above the minimum payment on that card. And that's important because if you're just making the minimum payment, the interest is outpacing what your ability to reduce the principal amount. That's how the credit card companies make money, is on the interest. So if you're making, let me give you an example. If you have, one of the things that I always share with folks, if you've got credit card debt, not only do you want to pay the minimum amount, you want to pay that interest amount as well. So if your minimum amount is 25 bucks and your interest payment is 75 bucks, then you should be paying 100 bucks every month, because that's the way you're going to reduce your interest payments and your balance. It's not with that minimum payment, because that minimum payment is really a trap. So keep that in mind. Pay that interest. So whatever that interest is, you're going to pay that along with your minimum balance and anything else that you can do above and beyond that. But that will help you reduce that card payment down rather quickly. This time of the year, another suggestion to help you pay down debt: when we get our income tax checks, use that money, some of that money, to help pay down some of your debt. You know, it's nice that if you get a nice income tax check, if you don't have any debt, you can put that in the bank. You can save it, build your emergency savings. There's a number of things that you could do with it. But if you do have debt, use that money to pay down your credit card debt or your other debt that you may have. And just make sure that over time that you're always making your credit card payments on time. These are things that are very easy to get you or help you pay down your debt. So now we've talked about debt. I want to focus on credit. So, we've all seen, the free credit score commercials that come out. But I want to just talk briefly about your credit score. Credit companies, anybody that's issuing you credit, be it a car loan or your credit card, they use your credit score to predict your future financial ability to pay. So your credit score affects your ability to make those larger purchases, whether it's your home or buying a new car or new furniture for your home, whatever the case may be. So you want to make sure that you've got a good credit score. So your score can be anywhere between 300 to 850. 850 credit scores over 800 are excellent, what you would call excellent credit. 750 to 800, even 700, I would say, to 800 is very good, or a credit score over 700 is very good. If your credit score is under the 500 range, then there's some work that needs to be done along the way. And again, this is one of those areas. Don't panic. Find out what your credit score is, and then we can talk about ways that you can build your credit. So your credit score really starts by showing how many credit card accounts that you have open, and then you kind of go from there. It's easy to figure out your credit score. You can go online, talk about that, but really, I would say to everyone, find out what your credit score is. If you have good relationships, if you're paying your bills on time, all of that goes towards your credit score. If you're someone just getting started out in your career and you need to build credit, very easy to do as well. You can get a store card or a gas card, and the key is just making sure that you keep that balance low and you pay it off on a regular, timely basis. There's also what we call secure credit cards that you can get. Those are the easiest things to get. That way, with a secured card, you put money on that card and you can only use the amount of money that is available. But that is a good way to get started with credit. But be very careful, be very mindful. A lot of times, every store you go into, be it Target, be it Walmart, be it Macy's, everybody has a credit card and they all want you to use their card. Well, that's all good and well, but you only need one maybe 2 credit cards, and you can go anywhere with those cards. So whether it's a Visa or a MasterCard or a Discover card, you know, they're taken just about by everyone. So keeping your credit score high is easiest when you make the right type of credit choices. Okay, um, so you apply for new credit sparingly. So as I said, you don't need a card by every store that you go into, but also particularly in this environment, look for credit cards that have low annual fees and lower interest rates. You know, again, the higher your credit score is, the better your interest rate is going to be. But keep in mind that you always want to make sure that you keep your credit limit under 30%. Because as your credit usage goes up, your credit score goes down. So, you know, that's something that's important. But make mindful decisions. Again, you don't need to put on a credit card something that you want just because you want it. You know, you use that credit card maybe if a need comes into play. All right, so think about that. Um, but have good payment history, making sure that you pay by the due date, not 2 days later, but on that due date. And again, these things may sound simple, but these are the things that are really going to be important in making sure that you maintain good credit history. So how do you go about monitoring your credit? You can monitor your credit through an app. You know, there's a very popular app that people use. I know Credit Karma is an app that you can download that will show you what your credit score is going to look like. So there's a variety of ways that you can do it. You can get your free credit report annually. Um, I think I'll talk about that in a second, but you know, it's easy to figure out what your credit score is. But the way that you're going to increase your credit score is paying your bills consistently, if you can pay your balance off each month, that is a positive, but you want to make sure that you at least pay the minimum at all times. Also, consider using your debit card because your debit card only goes towards the money that you have in your checking or savings account, as opposed to a credit card. One very important point though, if you and when you have your credit card paid off or you get yourself down to a zero balance, do not close that account because your credit score utilizes how long your credit history is on each and every card that you have. So just because you've got a zero balance, I know for me personally, I have a couple of different credit cards that are open that I haven't used in years, but I don't close them because if I close them, that will affect my credit score. So just because you're not using them doesn't mean that you necessarily need to close them. So keep that in mind. But again, this is one of those things that you want to review on your credit report, and it'll show you all the accounts that you have had open, how long you've had them open, the payment history, all of that information is available in your credit score. I want to turn here to something that is very important that I am always challenging folks to do, and that's your emergency savings. As I said previously, we don't know when it's going to happen, but we know it will. An emergency is always going to come up, whether it's a big emergency or a small emergency, if there is such a thing. But nothing can derail your savings faster than an unexpected expense. And in this example here, is a $1,200 car expense. Now, for that individual, that puts it on their credit card, and they are assuming this would be a low rate now, 18% interest rate, and you pay that off over 5 years. That $1,200 car repair turns into an $1,800 expense. So now Although you had that $1,200 car repair, you put it on a credit card, paid it off in 5 years, you paid an extra $628 for that $1,200 expense. That's what the interest rates will do to you. And I know now a lot of those interest rates are a lot higher than the 18%. I've seen interest rates of upwards of 32%, maybe even higher. So keep that in mind. That's how the banks or the credit card companies, that's how they make their money. So keep that in mind. So this is why it's so important, though, to have an emergency fund. So as I say, I'm always going to challenge you to build an emergency fund, but think about how large you want your emergency fund to be. Now, oftentimes when I'm asked that question, well, how large should it be? Think about setting some goals for yourself. Okay, I want to start off having 3 months worth of expenses. Now, that would be your house payment, your car payment, all of your expenses. You want to start with 3 months. Once you've gained 3 months expenses, then you take that out to 6 months. From 6 months, you take that out to 9 months, and then out to 12 months. Now, you can determine how long you want that to be. But this is one of those areas that I always speak of personally. Several years ago, I was working on the job. I fell on the job, broke my leg. I was off work for a total of 12 months. I had 2 kids in college, and I was very fortunate. We were very fortunate that I had emergency savings, but I blew right through it. And I was doing good. I had about 8 months worth of emergency savings that I went through. Well, that was just enough to tide us over and get all of our expenses taken care of. Because in my situation, I had a broken leg. I couldn't go back to work, couldn't walk, had 3 surgeries on my leg. But think about, I got 2 kids in college. I got car expenses. I got mortgage. I got all those things. It was the emergency savings. It wasn't enough, but it kept us afloat. So this is why it's important. I think very important for everyone to make sure that you have emergency savings. So again, when I talked earlier about setting goals for yourself, set some goals. How much do I need? How much do I think I need in case of an emergency? And I'll give you one unfortunate situation that is occurring across the country right now, where a lot of federal employees are being laid off. And I know many of these employees, they had government jobs, and they never thought they'd be without their job, and they didn't have, or they don't have, the necessary emergency funding to get them through. So it's an unfortunate situation, but I think it's a very good reason for everyone to visually see, and we all may know someone who's been affected when they are unexpectedly laid off, and now they've been living month to month, paycheck to paycheck. Now they no longer have a paycheck coming in. So how are they going to make their ends meet until they're able to find new employment? So, that's why it's important to really focus on your emergency savings. So get started. If you don't have an emergency savings plan, set some goals for yourself and set a timeline. Okay, I want to have X amount of dollars saved over the next 3 months. Set some goals for yourself along the way. And again, just goal setting, I think, is very important. Short-term goals, as you see here, can be getting that emergency savings fund started. You may want to have a little accessibility. Be careful with that. Too often when people start putting money in their savings account, they use their phone or their debit card, and they're transferring money between their spending habits and their savings. So be careful with that. Savings, emergency funds, savings funds should be just for that, but they are accessible in case of an emergency. But also focus on that long term. And longer term, you want to do some things that are going to earn you a little bit more money. than keeping it in a short-term savings investment. So there are all kinds of things that can be done. I'll be more than happy to address any questions that you may have along those lines. Don't forget to save in your retirement plan. That's always something that's very important. It's very easy. The 457 plan that the IndyPERS companion plan offers, take advantage of it because it's something that can really enhance your quality of life when retirement rolls around. Now, in your plan, there are pre-tax contributions. The beauty of pre-tax contributions at this point in time is that they reduce your taxable income. So again, it's just another compelling reason why. It gives you a dollar for dollar reduction. So when you're putting money into your 457 plan, you're reducing your taxable income dollar for dollar. What does that mean? Well, it means that maybe you're going to get a larger income tax check at the end of the year. So keep that in mind. It's really important that you work on saving how much you put into your 457 plan or any other savings vehicles that you may have. There's a variety of ways that you can save money, but it is always important to pay yourself first. That may sound simple, but it is important. You do want to pay yourself first. And paying yourself first may be, buying that new item that you've always wanted, but you've waited until you've saved enough money for it. There's a variety of things that you can do along the way. One of the challenges that I always tell folks, rather than your normal bank, do your emergency savings or just your basic savings, say at a credit union that is all the way on the other side of town. And the reason, and then you give that debit card that you will lock it up somewhere. Don't carry it around with you. That way, if an emergency comes up or if you need to get access to those funds, you've got to go dig that card out or go ask whomever you may have given it to for safekeeping to give it to you. And then you've got to explain why you need it. There are all kinds of ways that you can do this, but I think it's always important that you start to do the things that we've talked about in today's session. Once you've got your savings that can see you through any emergency that may come up, then you can start to have fun with the money that you've accumulated, whether that's buying that item or discretionary thing that you'd like to do. Maybe, hey, it's baseball season. Maybe it's going to a Major League Baseball game, or maybe it's taking a vacation, or buying a new car, whatever the case may be. Now you've got the resources set aside that you can do the things that you really want to do because it's not a burden on you financially. All right, lastly, just the takeaways, the things that we talked about. Remember, those 4 things. We looked at 4 core financial areas that will work to help improve your financial wellness. So first, creating a reliable budget. Putting together a spending plan that will work for you is at the core of everything. So it helps you have a clear idea of how much money you make, or how much money you have coming in, as opposed to how much money is going out. Then you can start working on paying down your debt. We talked extensively about debt and ways to pay it down, but I think the most important thing when we talk about debt is just stop adding to the debt. Then when you stop adding to the debt, you can be more effective working to get it paid down. Don't forget about credit. Look at your credit score. Make sound credit decisions, making sure that you're paying your bills on time every month. That is what goes to building a solid credit history. And lastly, we saw how all of this can culminate in extra money in your pocket to do whatever it is that you want to do. You do owe it to yourself. Once you've done these steps and you've done the right things, take some time and, do the things that you enjoy doing, whatever that may be. But these are the tenets of having financial security along the way. So, for those of you that have set up your accounts with Empower, just a real brief notification here. All you need to do is go to empowermyretirement.com. But on the screen here, if you want to add your access to your account on your cell phone or tablet, all you need to do is click on the QR code. The one on the left is for Apple, the App Store, and the one on the right is the Google Play. And that way you can have your Empower information right at your fingertips. And lastly, if you need to reach out to us or if you need to get access to your account, all you need to do is go to empowermyretirement.com, or you can call our customer care center at 800-338-4015. And they're available Monday through Friday from 9 a.m. to 8 p.m. Central Time, and Saturday from 8 a.m. to 4:30